people look at the residential real estate asset class either as something that you live in and the value ultimately comes down to price appreciation. And then there's another way of looking at it, which is cash flows. And there you can apply a cap rate to a property. The traditional investor understands cash flows from long-term rentals and appreciates the long-term leases that you can have in place. How are you seeing, as the market evolves, investors value short-term rentals? Just because you generate 60% more rent through Airbnb, are you rewarded for that when you sell the property to an investor? Or ultimately there isn't as much liquidity on that side?
Yeah, I mean, speaking from direct experience, we are actually in the process. We partner with an investor group. It's actually a group out of San Francisco. You're probably familiar with them, Zain, but I can't share them yet because the deal is not official. But we found a 43 unit asset portfolio for them in Charlotte, North Carolina. That's across 7 buildings that have been operated as short-term rentals for the last 7 or so years. And this group is now acquiring this asset based on our connection to this asset owner that's selling at a pretty healthy bump because of its of the financials and history financial performance from as short-term rentals. They're able to sell this for a larger sum than they would have if these were traditional long-term rentals because of the additional revenue that they generated.
And you know, the real magic happens when you buy a fundamentally sound property in a good location where you feel like it will appreciate, but then you can also generate yield from it and cash flow. And in that way, you might be able to set a floor price in terms of what is the lowest amount you'll get for the property because you've got the cash flow coming in. And then, you know, I own quite a bit of short-term rentals myself, and I have long-term rentals as well. And I've been quite surprised. You know, I came up with a model for short-term furnished rentals in San Francisco. And these were properties that people would usually buy as condos to live in for the long term. And if anything, these were, you know, appreciation assets. And even through COVID, the rents have been good, but we just for experiment, we decided to list some of these properties. And when people give you a lowball offer, it's very easy to turn around and say, look, we're making a lot of yield by renting this on a short-term basis. And suddenly that connects for people. Suddenly they'll give you a much better offer and they'll realize, okay, this is actually really safe. So what I'm trying to say is it feels like if you find a really nice property that you could live in, that you can imagine someone would like to buy, but you can rent it out, you create a lot of safety around that property. Gives you cash flow and you have a minimum price, you know what the property should trade for ultimately.
Yeah, I couldn't agree more. The sellers for that portfolio that I mentioned earlier are astonished by the deal, by how their investment has panned out. They're selling their entire portfolio. They're retiring. They got a golden visa. They're moving out to Portugal. They're done. They're extremely happy because of, no, don't get me wrong. This was great real estate, but the short-term rental revenue that they generated over the past 7 years just elevated the price to such an extent that, they're ecstatic about the deal.
And Amir, I'm curious whether you agree with this statement or not. The statement I'll make is that in order for a property to be traded as a short-term investment asset, like a short-term rental, you need history. You need a track record of consistent performance. Otherwise, I think it's very difficult for investors and even brokers to appreciate and understand how to value the asset. Because if you've had very lumpy revenue, there's been some seasonality, or you've had high vacancy rates and rents all over the place, it's a lot more difficult. Do you agree with that? Or are you seeing some speculation come in and people buying things without a proven track record?
People are buying things without a proven track record. And the reason that is honestly partially because of what we talked about just a second ago. The properties with a strong track record are commanding premiums. And the cap rates aren't as attractive for those assets that are being acquired. Now, in this instance, this cap rate makes sense because this acquirer is planning to build a large portfolio on top of this one. So this is like their first set of units, and then they plan to spend close to $100 million building a short-term rental portfolio. So most of their additional acquisitions are going to be on properties that don't have any historical data. They're going to rely on some of the tools that we've built out to help kind of understand the revenue potential of the property, know how the market is performing, and based on that, make pretty calculated decisions on what assets to buy. Now, transparently speaking, a lot of them are also smart enough to acquire assets they know would perform well as long-term rentals if things were not to work out at okay rates, at okay returns. But most of them are very comfortable with the revenue projections that we are able to come up and that we've so far have been able to perform towards historically.
What are the criteria for a good short-term rental? I know, and just to set context for some of our listeners at Rabbu, you often send out these weekly emails with real estate opportunities throughout the country, and you create a financial model where you estimate the yield it will generate if you managed it, which is a great lead generation tool for you. But how would you help us understand the criteria? What makes a good, what makes a short-term rental a good short-term rental opportunity?
Yeah, I mean, like most things in real estate, it's location based. First of all, you have to make sure that there's no regulations against that type of asset type in the city. So you always have to start there. That's the number one piece. Location is always number two. It really varies, but market by market. But the more attractive the asset, the better it will perform as a short-term rental. The more updates it has, the better furnished that it is, the more of an experience and emotion that it evokes out of an individual, the better it will perform. One of the kind of rules that we have, for example, in a market like Charlotte, which is big into breweries, like we say, if you're within walking distance of a brewery, even if it's a kind of transitioning area, that's a good Airbnb because people want to be around kind of transitioning, growing areas. So it's very location specific. The type and the size really also varies by location. We've seen some locations, in more urban, like center city locations, 1 and 2 bedrooms to perform better. Usually the kind of further out you get from center city, the more bedrooms you want this asset to have, because you appeal more to families and groups traveling together. There's no kind of like magic bullet. Say if you meet X, Y, and Z criteria, it's a great short-term rental. A lot of it is around how you set it up and how you manage it. But location, be close to points of interest. Make sure it's legal, and do your research on the data. If the long-term markets are performing well there, it might not be the best fit. Like Miami, for example. I'm currently in Miami. Our house that we're moving out of, the owner is getting ready to list it for rent for close to $10,000 after we vacated. We're nowhere near that, but it's just a market that long-term rentals demand in Miami right now because of the influx of people coming down here. So this is probably a better long-term rental than a short-term rental. So it really depends, but that's why we try to make the data available to investors and to operators so they can make that decision based on data that's available to them, that's in the marketplaces.
I'll share with you, you can also look at the types of short-term renters that come and go. So in heavily urban, densely populated areas where there's large office buildings, and pre-pandemic mostly, you would have a lot of activity during conferences and events. You'd have corporations as well who would be happy to sign up even for a long-term lease and short-term rates because they want the furnishing and everything else ready to go in the service. Then you also have other types of employers. You have the military, you have visiting nurses, which are close to hospitals, and you also have students. What do you think about the different types of tenants there and the employer bases? Is that something that you factor in when you're looking at the short-term rentals that you manage?
We absolutely factor that in. We also factor in migration to a city and the growth rate of a city. It's really interesting right now across our portfolio. Average length of stay is actually 44 days. Pre-COVID, it was about 2.5. And what we're seeing is a lot of people kind of living more of that nomadic lifestyle. They might be living in New York during the summer because New York is great in the summer. During the fall months, they'll go down to Nashville. During the winter months, they'll come down to Miami. It's just a new lifestyle that COVID and the remote culture accelerated. So we're definitely following those trends when we help identify markets where we believe investors should invest in, where we're seeing a migration of people come and wanting to spend time. That's created some really interesting opportunities. So it's less business, traditional kind of corporate business travel. It's more, the more business travel now is, hey, I can work from anywhere. So I'm going to go spend a month in Nashville and then a month in Austin and just check it out while working from that home.
Amir, a lot of people end up running their own property management firm, sometimes accidentally, by making an investment, taking calls, and then making another investment, and before they know it, they've got a portfolio of rentals. And this could be long-term or short-term. At what point does it make sense for someone to hire a professional third-party fee manager versus doing it themselves? Is there a point you've noticed where someone needs to go and hire infrastructure, or it becomes too occupying and you need to just outsource it? Is there a certain number or rule you have?
Yeah, I mean, for us, if somebody wants to self-manage on the short-term rental side, so transparently, I can't speak as much on the long-term rental side because we don't manage long-term rentals actively. On the short-term rental side, what we've seen a lot is people will want to manage themselves because they believe they can, reduce cost, which is fair if you think about it just from a cost perspective. There's some upside that you're leaving on the table by not being as actively managing things like revenue, especially with a short-term rental. But they're okay with 1, 2, 3. Once you get to that 3 to 5 property range in the short-term rentals, you're really running a small hospitality business, and you need to be on the beck and call of your tenants, who again are coming more often than your traditional long-term tenants. So it's much more hospitality than management. So we've kind of, once you get to that 3 to 5 unit count, we've seen people say, okay, I either have to do this full time or I'm going to pass this off. That's kind of the magic number we've seen so far.
Tell me about the fee structures that exist. What's standard in the industry?
Yeah, it really depends. So we've seen, in vacation markets, some of the larger vacation managers will charge upwards of 40% management fee to manage these high-end luxury rentals. The more kind of average management fee in your, vacation rental, short-term rental market is 25% or so of rental revenue. There are some groups that have some interesting models, like Evolve, for example. They charge 10%, but they're much less hands-free. So what I mean by that, a group like Evolve, they help you create the listing, they help do the pricing for you, they do the distribution, they find tenants for you, and then once the tenant has booked, they hand it off to you for you to, as the owner, to manage the actual experience that the guest has in the property. So there's a handoff there that they charge 10% for that. So really it's anywhere from 10% to 40%. For us, really the fee is not as much as important as the value that the property manager creates. Time, everybody always talks about time. Yeah, we'll save you time, but is the property manager utilizing the appropriate revenue management strategies to get you the best and highest revenue for your property? Are they utilizing it appropriately during the different time periods? During slower months, it's probably better to make it a monthly rental. During the peak season, it's probably smarter to utilize daily strategies to drive revenue. So a good property manager will more than pay for their fee that they charge you. So that's really the key piece there is the revenue management.